Can boring dividend investing beat the Nasdaq? I'm Sam Kovacs, co-founder of the Dividend Freedom Tribe, and that's the question that we'll be answering today. A few weeks ago, I wrote an article comparing the Nasdaq ETF QQQ to our boring, simple dividend investing strategy. And what we came to find is that over 4 years, our dividend portfolio has beaten the Nasdaq by a thin margin when we're looking at total returns. So far, the dividend portfolio has returned a total of 125% versus a total of 117%. It should be noted that if we looked at performance without dividends, then the Nasdaq is clearly ahead of us. But let's remember that the Nasdaq 100 has a very small dividend yield compared to our portfolio, which yields on average around 4%. And so, where does this performance come from and how does it work? Let's cut down performance year by year. And so here on this chart, you can very clearly see the performance of the Nasdaq 100, represented by the QQQ ETF, our hybrid portfolio, and the S&P 500's performance for the given years. Our portfolio was incepted in May 15th, 2020, just after the pandemic had begun. A lot of people were asking us questions, what's in store for equities, and we decided to share on Seeking Alpha a very simple strategy for dividend investors to buy low, sell high, and get paid to wait, which we believed would do as well as the indices. Well, fast forward, and we've not only beaten the S&P 500, but we've also beaten the Nasdaq by a thin margin, I'll admit, but this is quite the feat, right? We're dealing with stable, less volatile, steady as they go dividend stocks, moving in and out of them when the time comes, employing strategic sector rotation. And we've managed to go toe for toe with one of the biggest secular bull markets of this era, which is technology. Now, it should be noted that in the run-up from May to December 2020, the Nasdaq actually bested our portfolio, delivering returns of 41% while we were up about 30%, 29% to be precise. In 2021, however, our hybrid portfolio did better than both the S&P 500 and the Nasdaq. So this was an era where being long the Magnificent Seven was a surefire way to get good performance in the portfolio, right? Nasdaq 100 is even more so allocated to these securities than the S&P 500 is, and the S&P 500 also has these constituents as a large part of its market cap. We have none of these securities, so we are dealing in securities and building a portfolio that does not look like the indices look. This is why when 2022 came around and we entered about a year-long bear market, the Nasdaq 100 was down 32%, the S&P 500 was down 18%, and we were up 5.6%. This happened because we were able to see a certain pattern, which was that inflation was returning and that commodities would do very well as rates increased, and this is the strategy that we employed. We were overweight oil and gas for a long part of the period. And in fact, we were overweight oil and gas from 2020 to the end of 2022. And it was only in 2023 that we started considerably reducing our exposure to the sector. Now, this is where a lot of our performance comes from. When the Nasdaq 100 and the S&P 500 were down bad, our portfolio was up. And if you can avoid being down, remember Warren Buffett's first law in the markets is rule number 1, don't lose money. And rule number 2, don't forget rule number 1. If you can avoid losing money in bear markets, you set yourself up for success, even if you're investing in more conservative stocks, which don't have the crazy run-ups all the time that stocks like Nvidia, Meta, Amazon can have. Now, 2023 is where it gets interesting, right? Magnificent Seven in overdrive, the Nasdaq is up 54%, and we're only up 8.3%. So underperforming both the Nasdaq and the S&P 500 in 2023. Now, in 2024, we're about toe for toe with both of these portfolios, and I'd say that it's a year that's setting up to look similar to 2020 or 2021, where there's not huge differences in performance. Despite all of this, like I said, we have managed to beat the Nasdaq 100 over this period. And if I change the index to reflect the S&P 500, you can see that we've beaten it by an even larger margin, right? 125% for us, 104% total return for the S&P 500. So, what's more is that we've done this with betas relative to the S&P 500, which are much lower than the Nasdaq. As you can see on this chart here on the side, this little table, I've included the yearly betas relative to the S&P 500 for the Nasdaq and for our hybrid portfolio. As you can see, we systematically have betas which are lower than the Nasdaq. In fact, we usually have betas that are below 1. In some instances, like 2023, that wasn't the case, but otherwise we usually have a beta of, I'd say, around 0.85, which means that on average, when the S&P 500 goes up or down 1%, our portfolio only goes up or down 0.85% based on market variance, right? So the Nasdaq, in contrast, usually has a beta of, let's say, about 1.15, and that means that when the S&P 500 goes up 1%, the Nasdaq usually goes up 1.15%, and conversely when it goes down. In a market in which the S&P 500 then has gone up so much, you'd expect the Nasdaq to have beaten our hybrid portfolio, which has a lower beta, which is less volatile, but that isn't the case. Which begs the question, how did we do it? Now, our approach to dividend investing isn't rocket science. In fact, it's the very opposite of rocket science. It's a dumb, simple, easy to follow strategy, which does require discipline, but that any investor can do to get an edge. And it can be summarized by this core idea, which is buy low, sell high, and get paid. In fact, get paid to wait. How does this work? We all know that when we're buying securities, we want to buy them low and sell them high. This requires patience, which is why I enjoy dividend investing, because it gives investors a tangible return while they wait for markets to take care of themselves, for valuations to catch up, for the pendulum to swing from undervalued to overvalued. Of course, this brings up many questions, which is when is a price low and when is a price high? And there are many ways of addressing this, but one starting point which I like to use is our DFT chart. Now, this shows you the DFT chart for Philip Morris, ticker PM, and what it shows you is the price of the stock overlaid with different color ranges. These ranges represent the breakpoints between the minimum and the maximum dividend yield over the past 10 years, the median yield at the middle of the chart between the blue and the pink, and the 25th and 75th percentile yields in the light blue and light pink. So this shows you that 25% of the time PM was trading at a price which implied a yield between this level and this level. 25% of the time it's in a deep blue, 25% of the time it's in a light blue, and 25% of the time it's in the pink, right? So this gives just a very easy valuation metric relative to this stock's history of paying dividends, right? These are things that are best compared to a stock's history and not to the general broad market. So, as you can see, Philip Morris has recently had a great 20% run, and I think the last time we said to buy Philip Morris was probably early July, and then it ran up 20% since then. I'd have to double check that, but yeah, I believe 3rd or 4th of July we put a buy trigger on Philip Morris, and then it shot up. But had you bought Philip Morris in 2016, 2017, you'd still be underwater, right? Because, well, relative to its dividend and forecasted dividend growth rate, which you can sort of see by the slope here, well, we would have expected Philip Morris to revert to the mean, which of course it did. But as the pendulum usually overswings, it created this magnificent buying opportunity in 2020 and 2021, and then smaller opportunities 23 and a few in 24, as I pointed out, which if you bought low, then you could enjoy as the pendulum swings back into overvaluation, right? And you're getting paid dividends in the case of Philip Morris of 5 to 6%, depending on the entry, just to wait and for the market to catch up. Of course, this is backed up by fundamental analysis, growth prospects, and so on and so forth, competitive advantages. Is management actively building a moat, or is it disengaging the moat? This is all research that we provided the Dividend Freedom Tribe, and that goes beyond, of course, just a simple chart. But fundamentally, what we're looking to do is focus on the highest of highest quality companies, and when they're trading at attractive ranges, we buy them. When they're not, we sell them. Another good example is Pfizer. In 2020, and in the lead up to the vaccine, we identified Pfizer as historically undervalued and thought the prospects for COVID vaccine were quite good. We published multiple articles suggesting that investors buy Pfizer. And then conversely, as we were getting towards the end of, the end of 2021, beginning of 2022, this is when we recommended investors sell Pfizer. And we got a lot of backlash from this recommendation. People were saying that Pfizer's firing on all cylinders, the COVID vaccine revenue, blah, 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 blah. Well, what we did was just intersect our chart with our real world analysis, which was that the rate of vaccination was declining and likely to decline exponentially, as we've seen since. And that beyond that, Pfizer would have to face the loss of exclusivity in upcoming years on quite a few drugs. Now, this led, of course, to a massive decline, which I hadn't foreseen. And usually when we see declines like this, which happen aggressively, we tend to not buy on the way down because we believe that things can get a lot cheaper than you believe they will. And if you buy on the way down, well, you're just setting yourself up for a bit of frustration, being underwater 20% and 30% and 40%, even though ultimately you'll come back up on the other side. What I usually say is if you like to buy Pfizer at $35, why don't you let it bottom out and then buy it at $35 on the way back up? That being said, we do think Pfizer has reached the bottom, and we have started building a small position in the stock, which we will double down on if the price goes up more in upcoming months. Right, let's look at another example. Here we've got, I believe, Dick's Sporting Goods. Yes, Dick's Sporting Goods. Same in 2020. Most assets were cheap and a lot of liquidity was coming into the markets, so made it quite an easy buy. But euphoria quickly got us to sell within a year or two. And then as it declined, we bought again. The massive dividend increase, which you can see here with this big jump up, is one reason that got us to reconsider our ranges and include here a new buying section. For now, we're still holding Dick's Sporting Goods, and we'll target to sell sometime, I suppose, in 2025 if the stock price trends this high. One final example to finish up this article is Home Depot. With Home Depot, we were cautious and bearish on the stock in 2018, which proved to be good advice. Then going into 2020, we were bullish at the stock, and as you can see, we were bullish at prices that were equivalent to 2018, and it's the new dividend increases here which meant that we were happy and comfortable to initiate at a higher price. We always buy relative to dividend and relative to our prospects of future growth. and future dividend growth that will trickle down from the growth of cash flows. And so that's what we're trying to do. These DFT charts are a great starting point. Once again, we exited Home Depot gradually in multiple increments, getting very close to the top on our exit, and we've since accumulated another position and are now holding Home Depot once again, looking for it to pop back into a range of overvaluation sometime in maybe the second half of 2025. So this shows you our basic implementation of our strategy. We buy low, we sell high, we get paid dividends to wait. There's many reasons I like this strategy. Like I said, the tangible dividend is great, but it's not just great because it keeps you busy. It gives you a clear goal and yardstick to assess your progress as you invest. When ultimately you're going to switch from accumulating and saving assets to retiring, you're going to be spending part of your investments. I much prefer to be spending a cash flow that comes from a dividend than having to sell an asset to fund my expenses. People have disagreed with me on this. I've got lots of resources that I can send your way should you want to learn more. If you do, drop a comment, hit follow and subscribe. And I'll be seeing you around for more videos. We're coming back. We're going to be producing more content in upcoming weeks. You can follow me on X also at SamCovX, where I occasionally share insights on dividend stocks. I'll also be looking to build that up more in coming weeks. Thank you for watching. See you soon.